Inflation in Europe is at the highest level since the creation of the European Union, with the gross domestic product, the GDP of Europe as a whole, coming down near 0% since last year, meaning the European economy has grown by 0.4% over the last year, and some European economies even contracting over the last year, like Germany and the Czech Republic. The combination of slowing economic growth along with high levels of inflation is what's known as stagflation, and that could be what Europe is currently entering into. For the sake of this video, we can probably simplify the term stagflation to say that it's a combination of rising inflation and rising unemployment. So not only is the cost of your rent rising, the cost of healthcare, the cost of furniture, but also people are losing their jobs, businesses are failing, financial markets are tumbling. It's a pretty scary situation to be in. Before we take a look at Europe specifically, we can head on over to the United States because we actually had an episode of stagflation in the US in the 1970s. We had this vicious dual combo of rapidly rising prices, which you can see here with this red line. In 1975, core inflation in the United States hit 11%. But at the same time, we actually had rising unemployment rates. You can see here the black line rising at the same time as you had these large waves of inflation in the US. And it took over a decade for the United States to actually get out of this stagflationary episode between 1970 and 1983 before central banks were finally able to break inflation, as they say, which essentially just means getting it down back to reasonable levels, which is what happened throughout the 80s and 90s. Now, coming back to the situation in Europe, with all of these headlines around stagflation that we are seeing, is this what's in store for Europeans in the next decade? What does the ECB have to do with all of this? And why are so many concerned about a policy mistake? What does that actually mean?
The risk of a policy mistake has gone up.
And could it lead to something called hyperinflation? To answer all of these questions, we have to rewind to June of 2022 when the European Central Bank, the ECB, began to raise interest rates in order to fight inflation.
First time in 11 years, Joe, the European Central Bank raising its interest rate.
The European economy was quite hot at that time, with a GDP growth of around 4% relative to the year before. Now, this was in 2022, so this was 4% growth relative to 2021, where we had already seen quite a nice recovery following the pandemic. 4% is actually the highest levels of growth that Europe has ever seen going back to 2005, and that strong growth created a lot of inflation that the European Central Bank had to fight by raising its interest rate. You see, the European Central Bank is kind of the puppet master of all the European banks. The ECB is partially owned by all 27 central banks in the European Union, and this big master of all banks, the ECB in Europe, looks at inflation, they look at economic growth, and based on this, they lower interest rates to stimulate the economy when growth is low. You can see economic growth in Europe tends to pick up after they lower interest rates, and they raise interest rates to cool the economy down when inflation is too hot. And in 2022, they decided to cool the European economy down to fight inflation. And they've actually made some progress on this. You can see GDP growth is now at almost 0%, suggesting the economy has cooled down a lot compared to a year ago, where it was at 4%. Bankruptcies in Europe have been rising pretty much across all sectors throughout 2022 and 2023. You can see that little dotted line right there is the average number of bankruptcies across all different sectors, and you can see that's pretty much at the highest level we've seen since 2015. And surveys in Europe on businesses suggest that economic activity has been declining. This is the services PMI. It's a pretty well-known survey, and it shows that businesses in the services sector are currently in contraction to the same level that you typically see during economic downturns. 2008, this survey got to 46. In 2011, during the European banking crisis, this survey got to 46, and today it's at 46. These are kind of the things that you want to see when you're a central banker trying to fight inflation. It might sound a little bit sadistic, but this is just how monetary policy works. They want to cool the economy down, which means seeing these types of things on these charts in order to battle inflation. And of course, in the very best case scenario, lowering growth just enough to get inflation down, but not trigger a recession. But you see, that's where Europe starts to run into some problems, because inflation is not coming down, despite growth coming down quite hard. And that is what you call sticky inflation. Something you may have seen on news headlines more recently. While European inflation didn't get quite as high as in the US, it actually seems to be sticking around for longer. Core inflation in the US is coming down quite aggressively, much below the levels in Europe now. And in Europe, it's just staying there at 5% and not moving. It kind of begins to look like Europe is starting to get into this high inflation but low growth environment. And that is where the risk of a policy mistake increases substantially.
I think the risk of a policy mistake is very high.
That's a classic policy mistake.
So what's a policy mistake? There's two types of policy mistakes. Either a central bank raises interest rates too much and creates a financial crisis. They create a massive economic downturn because they raised interest rates too high. Kind of like what the ECB did here in 2008, raising interest rates despite the fact that we were heading into a global financial crisis. That was a policy mistake. But when you have inflation at 5%, meaning consumer prices are rising substantially, central banks actually risk more not cooling the economy down enough, which can cause inflation to spiral out of control and potentially head into hyperinflation. In general, and this is simplifying things way too much, but in general, if the interest rate is higher than the inflation rate, it puts downwards pressure on inflation. When the interest rate is lower than the inflation rate, it puts upwards pressure on inflation. If we want a very scary example of that, we see that in Turkey right now, that is currently experiencing an episode of hyperinflation. The interest rate in Turkey has been much lower than the inflation rate. And that is a really good thing if you want hyperinflation, which is exactly what Turkey is getting right now. In 1975, in the United States, we also had a policy mistake. This is the same chart that we just saw with Turkey, but with the United States, and going back a lot further in history, all the way back to 1957. And we can see here in 1975, the Federal Reserve cut rates very aggressively, bringing interest rates much lower than the rate of inflation that you can see here in black. And that actually led to another wave of inflation. That was a policy mistake that the Federal Reserve actually admits to in the present day.
Central banks, including the Fed, are very squarely take responsibility for inflation. That was actually not the case in the 1970s.
So lowering interest rates too quickly while inflation is still hot would be a mistake. This is why throughout most of US history, the interest rate has been higher than the inflation rate, in order to make sure that inflation is kept under control. The only big exception to that has actually been in the last decade, where central banks were actually trying to stimulate inflation because they actually thought that inflation was too low here. Now today, the interest rate is higher than the inflation rate in the US, so that's actually great news for the United States. It is so far successful in its battle against inflation. But in Europe, it's an entirely different story. The interest rate is still much lower than the rate of inflation in Europe. So here, if the ECB decides to stop raising rates, they are essentially doing so at a moment when monetary policy is still inflationary. So basically running the risk that inflation continues to run hot, which could even lead to a hyperinflation event like in Turkey. And unfortunately, that is absolutely a risk because of something called the wage price spiral. You see, there is a ratio called the vacancy to unemployed ratio, and it's currently at the highest level in Europe since 2004. That means the number of businesses that are looking for new employees is much, much higher than the number of people that are looking for jobs. And that means that employees have more bargaining power. They can ask for higher wages. If employees ask for higher wages, the cost of doing business goes up, which makes businesses increase the price of their products, and that makes the cost of living go up for everyday people and leads them to ask for higher salaries. So hypothetically, if the European Central Bank wants to avoid a hyperinflation scenario, where inflation goes through the roof, it needs to get this ratio down by continuing to raise interest rates. And that could actually come at the cost of rising unemployment in Europe. Remember those two things that make up stagflation? Europe is not quite there yet. They have the stubbornly high inflation, but unemployment is going down in Europe right now. Of course, if the ECB wants to avoid hyperinflation, it needs to get the unemployment rate trending higher. But what is the ECB actually saying about this? Christine Lagarde, the head of the ECB, is actually starting to get worried about economic growth.
Growth could also be slower if the effects of monetary policy are more forceful than projected.
She's even openly talked about potentially pausing monetary policy here, or as she says,
could be a hike, could be a pause.
Now, I'm not a central banker, I'm not here pretending I can do a better job than Christine Lagarde, but with core inflation in the European Union still above 5%, pausing rates here could have catastrophic consequences on inflation in Europe. As investors at Game of Trades, we actually published a piece on this back in July, showing why EZU, the European ETF, could probably have a lot of headwinds looking forward, and so far they've actually moved down by around 10%.